You've been learning about value investing, finance, just regular investment for a while now, but you don't know where to go next. You're getting confused about the vast amount of information on the internet. You don't want to waste your time on crap information. You want good information and reliable information. In this series of videos on value investing and finance education, you will find those answers to those questions and much more. My name is Jason Rivera. Welcome to Value Investing and Finance Education. Hey, Jason here. Today's episode of Evaluating the Qualitative in Value Investing, I want to talk about how to evaluate managers of a company. Managers, when I use the term managers, this usually means chief executives or the executive branch of the company. The executives who research, develop, and work to implement strategy. How do you evaluate them? This, for most people make this harder than it really is, in my opinion. My opinion is pretty easy to evaluate managers of a public company. What I do is, let's say I find a company that has passed my preliminary analysis checklist, and then I'm reading the financial statements. They pass my initial financial statement analysis, which is most recent annual, most recent quarterly, most recent proxy. Let's say they pass that. There's no major red flags I see in those. So then from there, I download 5 to 10 years worth of annual reports and read those going backwards in time. So if they go back into 2009, I start at 2009 and go forward to today. The reason I do that is because I want to see what their strategy has been over time that they've talked about in their annual reports and their shareholder letters. What strategies they've actually implemented. Have they worked? Have they not worked? Why haven't they worked? Are managers truthful when things haven't worked? Are they not boastful when things have worked? Are they blaming things on outside factors most of the time? And I'll talk about all that as we go forward. But this is how I begin building the kind of picture of how to evaluate managers. And when I mean evaluate managers, number one rule is when I evaluate managers is, can I trust them? If I don't believe, after reading financial statements, these up to 10 annual reports that I'm talking about, if I don't believe I can trust managers, I sell the company. Or I don't buy the company, no matter what the upside potential is, no matter what the undervaluation is, I don't buy it. So how do you quantify how to be able to trust managers? This gets a little squishier. I'll talk about some of the quantitative stuff here in a little bit, the numbers that I look for to evaluate managers, but this being number one, I want to talk about this first, and this is a little bit squishy. This will be a lot based on your personal biases, your risk profile, how much risk you're willing to take on, personal preferences, that kind of stuff. Things I look for to trust managers in the shareholder letter, in the annual shareholder letter. Do they talk about a strategy? Do they implement the strategy well? And over years, does that strategy work or not? If the strategy does not work, why does it not work? Are they truthful? Do they say, hey, something along the lines of, hey, we messed up, blah, 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 blah. Here's what we're doing to fix it. This is what we're going to do. This is what we expect going forward. We're sorry we disappointed you. Blah, 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 blah. That kind of stuff. That's good if they say stuff like that. If they, on the other hand, are blaming things on competitors and recessions if they blame everything on a recession and say they didn't see it coming and they weren't prepared and stuff like that, that's a red flag. If they say the recession is negatively affecting our results and here's what we're doing to fix it, Here's what we're doing to stem the decline. Let's say there's another major recession pretty soon. If during that recession you see people talking about, here's the recession, of course, is negatively affecting us, but here's what we're doing to fix it. Here's what we're doing to stem the tide. And it is realistic, and it's not blaming others 100% for everything. That's a good thing. If they are blaming others, it's not my fault, we did everything we were supposed to and things didn't work out, the recession is affecting us and it's going to continue affecting us and we have no control over things, we didn't see the recession coming, we weren't prepared for the recession, we weren't prepared for industry dynamics changing, we weren't prepared for new competition, we weren't prepared for major economic factors changing. These are not necessarily great things. Most of these, especially if they're blaming others, this is a pet peeve of mine. This is why I said we're just going to get a little bit squishy a little bit, and it's going to be largely based on your personal biases and preferences. If you're the leader of something and you blame and you don't take any responsibility and you blame stuff on other people, even if it is their fault, it drives me insane. Because you're the leader, you should have either prepared for that, you should have done better, you should have trained your people better. I'm a huge believer that you should try to control everything you can control. If you are blaming other people and you're taking no responsibility for your actions, it means, in my opinion, you're a poor leader. This is why politicians drive me insane. Because they're always talking about how it's never my fault, it's always the other person's fault or whatever. On both sides of the aisle. It drives me insane. So that for me is a major red flag. Another red flag. Things to look out for when it comes to this. Or annual reports, specifically, and proxy reports. Executive compensation. If in the shareholder letter and the proxy report they talk about how executives are compensated based on growth in market share, growth in revenues, growth in, the main ones you'll see is growth in market share, growth in revenues. That's a red flag. Yes, you want to grow revenues. Yes, you want to grow market share, but they shouldn't be the number one things that affect shareholder value, because that means people will make bad decisions. If you grow revenue 20%, but you don't grow your profits at the same time, they just stay stagnant, that's bad. Most of the time when this happens, though, if you grow revenues 20%, profits will go down. Free cash flow will go down. You want to see them kind of going up at about the same clip, or at least staying with cash flow and operating profits staying about the same. If you see them going down as revenues go up, it means the company's not controlling costs well. It means the company is not integrating potential acquisitions well. It means that they are not allocating capital well. Or it's one sign that they're not allocating capital well. Major red flag. What you want to see is them talk about growth in operating profits. We base our bonuses and income, or our bonuses and our salaries, incentives structure. You want to see that based on growth in operating profits, growth in ROICs, growth in shareholder value, stuff like that. Those are good things. You want to see that. If you see those things, or these are two major ways, and these are a little bit harder to quantify, and there will be more gray room in these than what I'm about to talk about next. But these help me trust managers. If I see things like this in the negative side of things, it's a very bad thing for me. It makes me not think I can trust managers. If it's on the other hand good, they talk positively about those things, that's a good thing. However, you want to see companies talk about growth in shareholder value, ROIC, and operating profits, you pretty much never see that. So you're gonna have to be careful with that one. Because frankly, I've seen that maybe a handful of times over thousands of companies I've evaluated. You don't see it very often. When you do see it, though, it's a very good sign. Another thing I look out for is, in the terms of trusting management, is Do company insiders and executives use shareholder funds for what I deem as personal things? Years ago, I was researching Wendy's, and Nelson Peltz, I think he owned it fully, Wendy's, or a big chunk of it, and he was the chairman of Wendy's, if memory serves me right. He's a billionaire, and Wendy's shareholders were paying for his security for his family. Again, I want to make as much money as possible. I want everybody here to make as much money as possible, but not at the expense of shareholders. When it comes to the expense of shareholders, that drives me nuts. Again, it was only, I think it was maybe $300,000 per year tops, but he's a billionaire. He can afford his own security. Another thing with that same Wendy's was executives weren't supposed to use the company private jet for personal reasons, but they weren't expressly disallowed from doing it. They also could bring their wives on the private jet if they had business, if the wives had business in the city they were going to. Now you can classify, this is like, goes back to the tax thing. You can classify anything as a business related expense. You can classify dinners. You can classify golfing outings. You can classify fishing outings. You can classify going to the opera, going to plays. You can classify anything you want if you work hard enough and you know what you're doing. You can classify just about anything as a business expense. That bothered me. That's another example. Extremely convoluted share structures. I remember, I think it was King, K-I-N-G, Digital Entertainment, before they got bought out by Activision Blizzard a few years ago. I did an analysis on them, and I'll link that below. I'll link those, I think 2 or 3 videos below in this video for reference. They had 8, if I remember right, 8 different share classes that all had different rights, all had different rights in terms of voting rights, all had different percentage ownerships. It was super complex, super convoluted. Didn't understand it. If you see that something like that, that makes it seem to me like shareholders or that executives and insiders of the company are trying to confuse investors by doing some of that kind of stuff, because it's so convoluted. It was ridiculous. That's another red flag in terms of my trusting managers. These examples aren't necessarily always illegal. Oftentimes they're not illegal. They're not even really immoral, but they just bug me on a personal level. Because they're not looking out for shareholders' best interests if they're using private jets for personal reasons, paying for security for a billionaire, even though the company's worth billions of dollars, tens of billions of dollars. $300,000 should be viewed as shareholder money instead of just it's $300,000 and we're a multi-billion-dollar company, we can pay for his security. It should be better used, in my opinion. So those are the main things I look for when it comes to trusting managers. Next up, get to the quantitative side, and this is where capital allocation comes in, that we've talked about a lot at length over the last 6 months on the blog. If a company's, let's say they have operating profits of 10% and they go on an acquisition spree, or let's say their operating margin is around 10% every year from 2009 and before, and then they start going on an acquisition spree, or new managers come in, or a new strategy is implemented, or whatever the situation is, and their operating margin declines from 10% per year on average to 2% per year on average. That's horrific. That is really bad. That's a really bad drop. That's an 80% drop in operating margin in 10 years. So if you see that, it's a red flag that the company managers are not allocating capital well. If they're not allocating capital well, they're not using shareholder capital well. If they're not using shareholder capital well, they're destroying shareholder value. If they're destroying shareholder value, they're destroying the value, intrinsic underlying value of the company. All bad things. If, however, you obviously don't want to see that. Same goes for ROIC, same goes for free cash flow to sales margin, Same goes for ROCE. Same goes for unlevered return on net tangible equity. If you see any of these or all of these at that kind of level and they drop significantly, or even a little bit, let's say it drops from 10 percentage points to 5 percentage points, that's 50% drop. It's not as bad, but you need to figure out what's going on and if it's going to fix, or are they allocating capital better? What's the strategy going forward? All that kind of stuff. But in general, if you see a huge drop like that, they're not allocating capital well, and they're doing all the things I just listed. If they're not allocating capital well, they're not doing the things I just listed, but they're also missing out on opportunities to invest their capital because if they're investing their capital well, the value of all of these things I just mentioned would be going up. Shareholder value, intrinsic value, value of the company, all this would be going up. This would lead to things like potentially more dividends, share buybacks, selling at a higher share price on the stock market, selling at a premium to a third-party company, all these things. This is where capital allocation comes in. Capital allocation massively affects the values of companies and shareholder value. So that is relatively easy to quantify. Another level I go to is, let's say you own a manufacturing company and the industry average, and by industry average I mean when I do this kind of analysis, I analyze the industry, the closest competitors for this company. I usually do 5. That gives you a nice range. Sometimes I think if you do more, it just takes a lot more time and you don't really get any more information out because the averages still are typically about the same. So typically I do about 5. So let's say you're a manufacturing company. I analyze that company itself that I'm researching, get its margins down, debt numbers, cash numbers, balance sheet information, all that kind of stuff. Put it in a spreadsheet, put those numbers in a spreadsheet, and get those same numbers for the five other of its competitors in the industry. If I'm a visual person, so this helps me kind of see on the screen, on my computer screen, who has the highest margins, who has the lowest margins, and try to get an idea of who might have competitive advantages in the arena and who does not, who has I can't remember the saying, not diseconomies of scale, but the whatever I'm missing, or it's leaving my mind right now, the term I'm looking for, the opposite of competitive advantages. But if, let's say, the company A, we're researching the initial company we found interesting, and we see it has 20% ROIC and the industry average is 12%. That's a very good thing. That means company A is earning 8 percentage points on average more per year in profits than their competitors. So they might have some competitive advantages. If they're small, they might have patents. They might have new innovative business model. They might have, a manufacturing company might have better distribution or better machining equipment or whatever. But you need to figure out the reason why they might have a competitive advantage. The opposite is also true. Let's say the industry average is 12% and company A this time has a 4% ROIC. Company A in the original example, when at 20%, is allocating capital extremely well. Company A in this example at 4% is allocating capital horribly, especially compared to the industry average of 12%. So this is another way to kind of gauge managers and how to look at them and how to think about them and how they are managing the company. If company A has the 4% margin, that means they're doing 8 percentage points worse. Means lower revenue likely, lower profit, likely they're at a competitive disadvantage, lower free cash flow production, all these things. Lower shareholder value, lower intrinsic value of the company. At 20%, all these things are reversed. They're all higher than the industry average, or they should be valued higher at least. So these are some of the ways I evaluate management. Again, the first part of what I talked about is a little bit more squishy. It will be kind of based on your personal biases, your personal preferences, risk profile, that kind of stuff, and personal pet peeves in my case. The second part about the quantitative stuff, the ROIC, the free cash flow to sales, operating margin, that is all pretty much straightforward. If you have an industry average of 10% and your company either has a lot higher, they're doing great potential investment, a lot lower, terrible potential investment, what's going on? You need to figure out what's going on in either case and see if it's sustainable. But that's a lot more easily quantifiable than what I talked about at the beginning in terms of gauging trustability in managers and executives. But this is exactly how I look at and view managers. This is exactly the process I go through every time I find an investment. This is how I think about when I talk to private companies for potential investors. If I know your industry has, let's say one of the companies I looked at not too long ago, or that I was helping not too long ago, was in the auto dealership, auto manufacturing arena overseas. I'm not gonna say where, overseas. They had, by my calculations, about a 1 to 2 percentage points operating profit margin, which is not, or doesn't sound great, but in that industry, that is actually pretty good. In that industry, profit margins are very slim. So if we could work to get, and this was exactly what I told him, if we can work to get your operating profit margin up by even 1 percentage point, here's XYZ on what's going to happen. Here's XYZ on what's going to happen to the valuation and the size of your company. It's just going to explode. Now, however, if you're comparing a company in the auto manufacturing and dealership arena to a consulting company, consulting companies can have operating profits margins of 20, 30, 40% plus. So that's not really an apples to apples comparison. That's why I said when you do a competitive analysis, you need to actually be comparing against competitors. Now, that's another topic for another day. I'm not going to get into that right now. I want to keep it on topic here. So these are the ways I view how to evaluate managers. These are some of the ways how I view managers, or how I evaluate the quality of management. I'd love to hear your thoughts on how you evaluate management. Did I miss something? Should I add something to my repertoire that I didn't talk about today that I should share with everybody else? Because this isn't all that I look at. These are just some examples. Did I explain something wrong? Let me know in the comments below. Did you love the video? Let me know in the comments below. We're always looking to improve here. We're always looking to get better, and we're always looking to bring as much value to you as humanly possible. So let us know in the comments below how we can do that for you. I hope you're enjoying this qualitative value investing series. We've covered a lot of ground already, and we're going to continue doing it. And hopefully this will help you enormously in evaluating companies, because the qualitative side of things is not talked about very much, because people don't like talking about squishy, kind of fluffy, kind of gray area things. They like talking about the numbers when it comes to investing. Most of us are numbers people, at least at the beginning. So, but this is the qualitative side of things, is how Warren Buffett is, in my opinion, the main reason Warren Buffett got to where he is, because he learned how to evaluate management, how to evaluate competitive advantages, how to gauge long-term sustainability of this competitive advantage, so you can get a massive advantage over other investors by learning this kind of stuff. If you're watching on YouTube, make sure to like, love, share, subscribe, comment, and hit the notification bell so you're notified anytime we release a new video. And we're releasing new videos all the time. If you're listening on the podcast, make sure to like, love, share, comment, subscribe, all that good stuff as well. We greatly appreciate it. We'll continue this series and our other series. And until next time, have a great day. Talk soon. Bye.